Welcome back, everyone. I am so excited to share this explainer with you today because, honestly, we're looking at something that fundamentally changes how we understand financial markets. We are going to explore a groundbreaking research paper that introduces M3, a market microstructure model. If you've ever wondered how artificial intelligence is moving beyond just generating text or images and is now actually simulating complex economic systems, well, you're in exactly the right place. Let's get right into it.
Okay, so real markets only give us one timeline, right? Think about it. When a massive trade hits the stock market, we see exactly one outcome. We just don't know what would have happened if that exact same trade was split into smaller pieces, maybe delayed by 5 minutes, or executed while the trader was out grabbing a coffee. We completely lack a counterfactual. But what if we could build a crystal ball to see how different interventions would have changed the outcome? What if we could literally generate multiple hyper-realistic market trajectories? Well, that is exactly what the researchers behind the M3 model set out to achieve.
Which brings us to Section 1, the single timeline problem. To understand why M3 is such a massive breakthrough, we first have to tackle the core limitation of only having one realized path. To do that, we need to look closely at the engine room of modern finance, the limit order book, or LOB. Think of the LOB as the ultimate playing field where all market liquidity lives. If we zoom in closely on the raw data, it's basically a highly structured snapshot. It shows us the best bid, the absolute highest price someone is willing to pay, and the best ask, which is the lowest price someone is willing to sell for. The gap between them, that's your spread, and the total volume available at all these different price levels makes up the market depth. This structured book defines the exact state of liquidity at any given microsecond. Now, historically, it's been practically impossible to accurately model markets because of a massive data disconnect. On one hand, you have the unstructured players. These are the order events, the irregular, rapid-fire records of price, volume, action, and time. On the other hand, you have the highly structured playing field, the LOB we just talked about. And here's the kicker. These two are constantly reacting to each other in a messy, instantaneous feedback loop. Traders submit orders based on the current LOB, and those very orders immediately update the LOB. Trying to simulate this continuous, heterogeneous interaction without the whole system instantly collapsing into totally unrealistic chaos, yeah, that's been the white whale for quantitative researchers for years. So how do we fix it? Let's move to Section 2, translating markets into tokens, and see how these researchers brilliantly solve this fundamental disconnect.
Their solution? Discrete tokenization. Just like ChatGPT translates English words into discrete tokens to predict the next word in a sentence, the M3 model essentially creates a language of the market. The researchers take continuous, complex market features, things like price, volume, and the time between trades, and push them through a vector quantized tokenizer. Basically, they're rounding off messy, infinite numbers into neat, discrete categories. It's kind of like sorting thousands of unique shades of blue into just light blue or dark blue. But here is the absolute most brilliant detail of their methodology. Instead of anchoring prices to the constantly moving mid-price of the stock, which, trust me, causes massive compounding errors during a simulation, they anchor their tokens to the daily open price. This gives the model a fixed, reliable compass, letting it capture long-range price movements perfectly.
That takes us to Section 3, building the M3 architecture. It is incredibly fascinating to see how they built a hybrid foundation model to process all these market tokens. I want you to think of this architecture as a continuous, self-feeding loop. Step 1, a dedicated LOB encoder compresses the current market state into continuous prefix tokens. Step 2, the raw order events are tokenized. Step 3, an autoregressive transformer looks at both the market state and that sequence of past events to predict the exact next order token. And finally, Step 4, and honestly, this is where the magic happens, that prediction is decoded and fed straight into a deterministic matching engine. This engine physically updates the simulated limit order book in real time. It's perfectly replicating the strict, rule-based mechanics of a real-world exchange, entirely ready to start the loop all over again.
Of course, to make a loop like this actually work, M3 had to be trained on a massive, massive scale. We are talking about 31.9 billion order events. 31.9 billion. This data was extracted from real stock market history, covering 800 non-overlapping equities from the CSI 300 and CSI 500 indices over almost 2 full years. This isn't just some toy model working in a vacuum. It's a true foundation model trained on immense, high-frequency reality.
Which leads us right into Section 4, scaling laws and stylized facts. Because when you feed a model this much real-world data, something amazing happens.
First off, the researchers proved that M3 actually follows a predictable chinchilla-style scaling law. Simply put, its performance mathematically improves as you scale up compute and data, exactly like the biggest AI text models out there today. But more importantly, let's talk about how M3 compares to older simulation models, like the Zero Intelligence Baseline or the Hawkes baseline. When we look at statistical distances, like the Wasserstein distance or the KS statistic, a lower number means the simulation is much closer to human reality. And M3 scores, they are drastically lower than the alternatives across the board. It proves that M3 incredibly mirrors real market laws, which quants call stylized facts. It easily captures super complex dynamics, like aggregational Gaussianity. That's a fancy way of saying short-term returns have wild, heavy tails, but they smooth out over longer horizons. And M3 does all of this naturally, without collapsing into random chaos.
Because it can model this crazy complex behavior so accurately, M3 can actually extract real predictive information. By running multiple Monte Carlo simulations of the future, literally spawning dozens of different market timelines, the model can accurately forecast short-horizon price movements. It can even successfully predict whether the market is about to enter a state of low or high volatility. And that matters profoundly, guys. Understanding the underlying physics of the market state is pretty much the absolute holy grail for forecasting financial risk.
And finally, we reach Section 5, Simulating the Market Multiverse. So how do we actually take this generative foundation model and use it in the real world? Well, it allows researchers and quants to run true what-if analyses. Like we said earlier, it's a literal multiverse simulator for finance. You can perform directional stress testing. Imagine artificially injecting massive buy or sell pressure just to see exactly how the market's liquidity would absorb the shock. You can test large, time-weighted average price, or TWAT meta orders completely safely without risking a single real dollar. In fact, in their paper, the researchers proved that M3 naturally reproduces the famous square root law of market impact. That law shows that as you execute larger and larger orders, the price impact scales in a very specific concave square root trajectory. The wild part? The model learned this fundamental economic law entirely on its own, just from looking at the data.
And best of all, the researchers aren't keeping this locked away in some corporate black box. They have totally open-sourced the code and the model weights, making them accessible right now on GitHub and Hugging Face. By putting this tech out into the wild, they are empowering the entire quantitative finance and machine learning community to build upon this state and event framework, pushing the boundaries of market simulation even further. It is a huge win for open science.
Which leaves us with a truly fascinating final thought to ponder. We've already seen how large language models conquered human speech. Now, models like M3 are beginning to decode and completely simulate the hypercomplex micro-interactions of the global stock market. So, if we can successfully simulate alternate realities of limit order books today, what vast interconnected economic realities will we be able to simulate and stress test tomorrow? Thank you so much for joining me on this explainer. I really hope this helped you grasp the sheer incredible potential of generative foundation models in the world of finance. Catch you next time.